Wow, ladies and gentlemen, the S&P closes down 4.75% today. Almost a 5% close. The nasty NASDAQ closes down 5.9% today. Holy guacamole. Wow. Ladies and gentlemen, I'm sorry to tell you, this is not the end of the correction, okay? This is the start of a bear market. Yes, I'm sorry to break it to you. We've been talking about this on the channel for a while now. Tomorrow, though, is a huge day, a massive day. And I will explain why in this video. I think it's an even bigger day than it would have otherwise been, considering today you were down almost 5% on the S&P. Tomorrow's going to be another really bad day, or potentially you could see a little bit of a recovery. But there's a problem with that for tomorrow. Even if things go as good as you could possibly expect, it doesn't change the fact of today. The fact of today is Donald Trump, whether you like it or not, seems dead set on pushing the economy into a recession. It seems like that is the idea, and tomorrow's not going to change that necessarily. It could speed up or slow down the timeline of that, sure. But the way I see it, tomorrow is a bigger downside catalyst than an upside catalyst. There's not really a way for tomorrow to save the markets. But there is a way for tomorrow to be really negative for markets. Again, if you speed up that recession timeline. So here in this video, I will indulge you on what happened today in markets, why this is not the end of the correction, more likely the start of a bear market, and what could be coming tomorrow. So, I mean, there's a lot to get into here, but essentially, it's all about a recession at this point, okay? These tariffs, from all indications that we're getting at least today, they're probably not going away anytime soon. Now, I'm sure there's going to be negotiations. I'm sure there's going to be, concessions here and there and quote unquote deals made. But it doesn't seem like it's going to happen fast. Okay? And tariffs like this are, as Goldman Sachs said today, a shock to the economy. The economy is really diversified, quote unquote resilient. It's very good at handling negative events. Banking crisis back in 2023, no big deal. Economy didn't even bat an eye towards it. Okay. Well, again, that's the strength of the economy. But this is a shock. The economy is not good at handling shocks. Shocks are what causes recessions, okay? Now, we already have a confidence issue. We already have consumers pulling back, and now you're adding this shock to it. Especially if these tariffs stay on, for a extended period of time, there is no way around a recession. Now, a recession's like a polarizing word, okay? 2 quarters declining GDP with usually a weakening labor market, okay? Very kind of polarizing word. Stagflation, also another polarizing word. It means stagnating growth and higher inflation. That's kind of the camp that some are in right now as well. I'll tell you, you're not going to have an inflation problem if you have an economic growth problem. The two don't go hand in hand, because as businesses, you can't raise prices if people stop buying your products, right? If people stop buying TVs, you can't raise prices on those TVs. If anything, you're going to cut prices. That goes for any product in the world, besides food to a certain extent, but people will even slow down there. I mean, have you ever been in a hard time in your life and Maybe you eat less, right? Without getting too far into that, I think we all know the intricacies of what happens during a recession. Tomorrow, it's not going to necessarily cancel any kind of recession. It could speed up the timeline, but it's not going to cancel it, and nothing really is going to change this recession outlook besides these tariffs getting dramatically rolled back. Like Donald Trump nuked the economy. Let's be honest. That's why the S&P is down 5% today. He nuked the economy. There is no easy fix to that. The other part of this is, even if somehow miraculously we avoid a technical recession, miraculously, okay, somehow we don't have declining, 2/4 of GDP, somehow the labor market holds up, company earnings will be impacted from this. Goldman Sachs had a report out today that operating margins could fall 32% on the S&P. That, my friends, we're not priced for. Wall Street is not really expecting that. Now, okay, fine. But what does this do mathematically? Okay, because it's all fine, it's all dandy, whatever, recession, no recession, blah, blah, blah. If you want to boil this down to numbers, it could be really bad, okay? If EPS declines 15% this year versus last year, which in light of these tariffs may be generous, right? Maybe a 20% decline on EPS could be possible, okay? We'll go with 15%. That brings you to EPS of about $201 per share for the SPX, okay? S&P, it just basically times it by 10, right? So $201 of EPS for the S&P. Times that by whatever multiple you want to apply. Times it by 18. You're looking at 361 on the SPY. Well, today you're at 537. So 361 from here after our 5% decline today would give you downside of roughly 33%. Okay, from peak to trough, from the all-time high of markets to 361 would be ultimate downside of 41%. Okay, now you can tweak these numbers however you want to. That's the beautiful thing. You want to call it $210 of earnings times 18? That gets you to 378 on the SPY. 378 from here is downside of roughly 29.5%. You could tweak these numbers a little bit further. You could say we're going to have $190 of EPS because tariffs are going to hit company margins and they don't go away. And this is more of a, I don't want to say worst case scenario, but more of a bad case scenario times 18. You're looking at 342 on the SPY. 342 from here puts you almost exactly back to your 2022 lows. That'd be downside of about 36.5% from here. Okay, and your 2022 lows, I think, is probably where you would find a lot of support coming in for markets, and that's at 336. Okay, so you could tweak these numbers however you want. You could say $200 of EPS times the middle range multiple during a recession is 15.5x. Okay, that's 310 on the SPY. 310 on the SPY from here. This is fun. This is fun, isn't it? 42.5% down from here. So hopefully you're picking up what I'm putting down. That's why this is the start of a bear market. There's no way around this. You can tweak your numbers however you want to, and you're still looking at 20+% additional downside from current levels. That's the fact of the matter. That's why this is the start of a bear market. Okay? There's really no other way to put it. Now, what you do next and what you do right now can prepare yourself for this. You can either be a victim here and have the victim mentality, or you can benefit from this. You didn't create this. It is not your job to hold moral accountability for yourself. You did not create this problem. If you want to put yourself in a position to benefit from this problem, by all means, that is a good thing you should do for yourself and your family. If you don't, the next guy will. And I know not everyone's going to like this take. Not everyone's going to understand what I'm saying in this video. Not everyone's meant to profit from this recession and or bear market that we are about to witness. But if you are one of the lucky ones, you will come out on top here. And it's actually more simple than you think it is. If you own stocks that need to raise capital, they're gone. Sell them. Now, I'm not a financial advisor. I'm not a financial planner. Come to your own conclusions. We're not going to fall in a straight line. So after a 5% decline, I don't think you necessarily have to go out and sell those stocks today. You're probably going to bounce at some point, right? Tomorrow could be a bounce. We'll have to see. But again, anything during a recession that would need to raise capital is gone for sure. Even if you're, own companies that have done very well, that, stocks are up a lot, you have gains, and maybe they don't need to raise capital, but they're risky overall. Those stocks are gone. Okay. In this environment, I want quality names. Okay. So that's number one. Getting rid of those bad companies. Because by all means, if you want to own those stocks, you will have a chance again at much lower prices, right? If you're talking the headline S&P could fall 40% from here, what do you think those small caps are going to look like? What do you think those, high risk companies are going to look like? You could have a 100x, 50x buying opportunity, right? You could buy some of these stocks back at $2, $3 a share and watch them do very well on the recovery side of this. But those are the last stocks you want to own and ride lower. I think a lot of us learned this lesson the hard way in 2022, right? We all owned some stocks that we probably shouldn't have in 2022 and just rode those suckers all the way down. Sure, some of them recovered. Affirm recovered. SoFi recovered. Okay? But it's not a mistake you want to make twice. Okay? So that's number one. Number two is absolutely no. You do not want to have any margin. Zero margin. Not $1 of margin. Even if you want to stay fully invested in markets, margin is your tool. If markets are down 40%, your portfolio is going to fall a lot as well in that process. But you will have a capacity to use margin to buy depressed assets when that time does come, as long as you don't have margin debt right now. That is the last thing you want to do. Staying fully invested in this market historically is a good idea. And I still think that's probably a good idea. But having margin right now is the worst possible financial mistake you could make. And finally, cash is king. If you want to hold some cash right now, that is fantastic, because something very interesting happens when stocks fall. Your money becomes more valuable. Your purchasing power goes up. Okay, so it's like deflation, right? Pretty simple. The basics. We should all understand this. When inflation goes up, your purchasing power goes down. Meaning, when stocks go up, your purchasing power goes down. When you get a bit of deflation and stocks fall, your purchasing power actually skyrockets. Okay, so People are looking at money, I think, in the wrong way right now, especially considering markets are probably going to fall a lot more from here. Each dollar is worth 5 to 10x a dollar. Okay, so if you have $100 of free cash at the bottom of a recession crash, it's really like having $500 or $1,000 if you invest that money and hold it for the recovery, right? So amplify that with the amount of money you have. 10,000, 20,000, 30, 40, 50,000 could turn into $500,000 or more on the recovery. Okay. And there's going to be some stocks that do very well. Like Carvana was a $3 stock. Today it's still over 200. And at one point was almost to 300. That was 100x from 2022 lows. Your dollar went a lot further in 2022 than it even is now. That's why cash is king. You can actually think of it like you're getting paid to sit in cash, because when you ultimately put that cash to work, you're going to get a lot more for your cash. Okay. So those are the things that I'm kind of doing right now. And I'll tell you one reason why this correction or crash is not over. And it's TLT. TLT was up less than 0.5% today. It's up 0.28% in after hours. But the S&P was down 5%. There is no fear out there. Yeah, sure, you're looking at the VIX that is hitting highs, blah, blah, blah. Who gives a rat's ass? Okay. If we were really fearful, the VIX or TLT would be skyrocketing. There would be a rush to safety. Now, there was some speculation today that maybe someone got blown up. Maybe someone, a large firm, maybe was leveraged in stocks. They kind of got blown up. They had to sell their TLT as kind of their anchor in their portfolio. And that put downside pressure on TLT today. Whereas without that, you would have seen it up 3 to 5%. On days of real fear in bonds can routinely go up 3 to 5% in a single day. That is not uncommon, right? Or have multiple really good days in a row. Like October, November of 2023, right? I mean, you went through a correction during this time. What happened to TLT? TLT went from $77 to $95, but specifically right here, you went from, 88 to 94 within 2 days. Okay? You don't have fear in the bond market. If I can sit here and tell you we're going into a recession, and a lot of people are also saying that, they're talking about the Smoot-Hawley Act that helped cause the Great Depression, which was one of the worst legislative bills that has ever been passed. If these Trump tariffs are like magnitudes worse than that, and we're all starting to talk about a recession, why are bonds not reacting? Okay, it's because people are not really fearful. Sure, VIX is up. People are getting into a couple hedges here and there, but there's no fear. XLP, consumer staples, were green today, almost hitting a new all-time high, up 0.58% today. There is no fear out there. Okay, that is why partly this correction is not over. Okay. Now, coming out tomorrow, you will get non-farm payrolls for March. As I've said before here on this channel, I think the input data is just messed up when it comes to non-farm payrolls. I think some of the data, like this report we're getting, is probably not as reflective for March as it is for like February. I think February's data is really what we're getting here. That is when you should start, or from what I've seen, February is when you started to see more of the weakness, more of the layoffs, more of the uncertainties, right? Consumers really slowing down. So tomorrow could be the report where you do see some material weakness. Expectations are kind of all over the place, as high as 135,000, as low as 80,000. Unemployment rate is expected to be around 4.1%, although it could jump to 4.2%. Here's the deal. as I said at the beginning of this video, if non-farm payrolls come in high, above expectations, it's kind of like a nothing burger, because that suggests maybe we're not in a recession right now, but these tariffs will push us into one. So it slows down the timeline for a recession potentially. Is that really good though? Well, it's not bad, but I wouldn't call it good. It doesn't change much. Now imagine for a moment non-farm payrolls come in at 40,000 or negative perhaps. All of a sudden, everyone now will think we're already in a recession. Damn. A headline just hit right now. Ugh. That's a rough one. Trump trade advisor Navarro says tariffs are not a negotiation. Everyone's been kind of thinking tariffs were a negotiation, and there's a little bit of that after hours little pop that's going away. TLT is getting a little bit more of a bid on that, now up close to 0.5% in after hours. And there could be a bit of a delayed reaction on TLT. If someone did get kind of liquidated, then maybe we see TLT actually respond and move materially higher over the coming days. The technicals on TLT definitely look good. Yeah, and there's more headlines coming out from Navarro right now. Navarro says, let's see, tariff rates are half of the sum of all cheating. He says tariff calculations are based on sophisticated analysis. Yeah, that's a way of putting it. And Trump trade advisor Navarro says tariffs are here to protect Americans and boost revenue. So it looks like they're just doubling down even more on the whole tariffs are here to stay thing. And we'll see if there's truly a Trump put. I mean, it's going to come in when markets are down like 20%, but that's still kind of up in the air. Nonetheless, again, a weak non-farm payrolls report, a high unemployment rate, speeds up the timeline for a recession. Instead of people saying a recession is possible later this year, people are going to start asking if we're already in a recession. And that's what's big about tomorrow. That's why I see it more of a downside, as a potential downside catalyst, than something that could save the markets per se. Now, Fed Jerome Powell will also be speaking at 11:25 in the morning tomorrow. We have our reciprocal tariff announcement. We're going to have non-farm payrolls, some of the other hard data in recent weeks. You should see Powell take a more clear stance one way or the other. Right? He's either going to double down on we need to wait and see if there's inflation that's going to be caused here, or probably, again, depending on what the non-farm payrolls look like, you could see Powell flip to we should start considering, cutting rates. Okay. If non-farm payrolls are negative, for instance, you're going to get a Powell that sounds very concerned about the economy. And I think Powell actually loves this, because no matter what happens, no matter if Powell cuts rates, holds rates, lets the economy go into a recession, cuts rates, and just gambles on what inflation is going to do, doesn't matter. Powell loves this. Because why? He's not going to be blamed for it. You go into a recession, it's not Powell's fault. It's not Powell's fault that the economy had a hard landing. It's Trump's fault because of tariffs. If the Fed cuts rates to accommodate the economy and inflation spikes, it's not Powell's fault. It's tariffs' fault. So I think, honestly, Powell's kind of in a win-win position either way from that regard. So we'll see what stance he takes tomorrow. And I think it's really going to come down to what the jobs report says. If the jobs report says things are fine, you're going to get more of a wait and see from Powell. If Powell says, if the non-farms are bad, you're going to get more of a, scared Powell. And again, for Tesla stock today, you did better than other big tech names. I mean, Apple was down almost double what Tesla was down. How often does that happen? Okay. I think over the coming weeks and months, there is going to be the winners and losers of tariffs that are picked out here. Okay. And I think Tesla should benefit from that perspective. But again, if we go into a recession, nobody's really going to benefit from that. Okay. And that's kind of what is happening. So even though Tesla is barely impacted by tariffs at all, it's still sold off 6% today because of that recession risk. Now it's holding up a lot better than other stocks, which is a good thing to see, but it's going to follow what the broader markets do. That's the reality of the situation. So be prepared for that. And honestly, again, with some of these comments coming out from Navarro, they're not trying to help the markets. There's no love lost for what stocks are doing today. So let me know your thoughts on all of this down below in the comment section. Ladies and gentlemen, have a fantastic rest of your day, and I will see you in the next one.